came up immediately, and there was this paper by Bertola and Caballero in 1992 that introduced the idea of, honeymoon, the divorce, the opposite. So the idea of setting up this target when this target is non-credible creates the opposite effect. In fact, so rather than stabilizing the exchange rate, in fact, it accelerated the departure from the target, right? And so I can go directly to the main picture rather than having, this is the basic idea, right? So you have on one hand the target here, the target for the exchange rate, the E bar, and then if this target is credible, then you have this trajectory that Krugman quite nicely managed to devise, and quite brightly, smartly devised. And then the idea of a divorce, namely you see a trajectory which goes in the opposite direction, right? So this was the literature of the time. In fact, what happened was that, with the evolution of this literature, some other contributions endogenized the divorce. So there was another contribution by Krugman and Rothenberg that in fact showed that the credibility, rather than being as it was in the previous divorce case of Bertola and Caballero, rather than being exogenous, depending on some exogenous probability that the target would be overtaken or not, could be endogenized, right? So some surveys, and so the literature has gone on, but then the literature sort of faded away. There was no more interest and no more applications. And then I thought that, with the crisis, with the public debt crisis, I thought that the euro area public debt crisis, I thought that there might have been some possibilities to resurrect this literature and to let me. I had your faces. It's better to have your. It helps me to see you there rather than not seeing you there. So let me put back the image, your images. So what I did was to try to apply this idea, the same idea, to a different issue, to the issue of the speculative attacks on public debt in the euro area, in EMU. And so a couple of papers got published, Macroeconomic Dynamics, Journal of Macroeconomics, where I basically applied the same idea, the same story, and then another paper, International Review of Economics and Finance. And so what I did, however, was also to apply the same idea again to a different problem, to a different issue, to the issue of the current crisis, call it as you want, backlash, slowdown of economic globalization. And again, here there might be, we'll see, the idea of applying the same story, a target that might be credible. If it is credible, this means that the fundamental driving force can get stabilized, but if it's not credible, can actually work the other way around, can actually accelerate the departure from the stability. And so I have a paper in which, this World Economy paper, in which I basically approach this idea of honeymoon and divorce and apply it to economic globalization. And then I have another piece of paper in which I consider the case of the divorce, but in which agents, rather than being homogeneous, are heterogeneous. And I will show you what it changes in the story and why it might actually depict a bit better the situation.
Pompeo?
Okay, let's see. Yes.
What is when you are talking about globalization, what is the target here?
Yeah, I'm going to show the paper. I'm going to briefly outline the structure of the models in the different cases. Okay. So if you are patient just a little bit, I'll get there. So this is the structure of the exchange rate target zone model, right? So you have 4 equations. The first equation is very simple. The model is very, very neat. I mean, there are some techniques. I'm not an expert, a mathematical expert. I'm not but it's very, very intuitive. So you have an equation here, equation number 1, that says the exchange rate, ET, is a function of a given driving force, a given fundamental variable. Can be monetary policy, can be GDP, anything. You can think about the monetary model of exchange rates, in which you have monetary policy driving the exchange rate. So the exchange rate moves linearly with a given driving force, with a given fundamental variable, F. But there is also a self-fulfilling component, the second part. So the exchange rate not only reflects the value of the fundamentals, but also reflects the expectations of market participants, right? So the exchange rate reflects the current value of the exchange rate, reflects the expectations of the variation of the exchange rate itself. With a given parameter, with a given beta, this beta tells you how much these expectations are affecting the exchange rate. Okay, so this is the technical part, right? But you shouldn't worry. I mean, these are technicalities in this modeling. This fundamental is assumed to evolve randomly following a stochastic process, following this arithmetic Brownian motion, and you have this, therefore, the variation of the fundamental, which is given by this expression. Irene, don't worry, it's nothing to be worried about. It's
there's no test at the end, but okay.
It's a technical part that moves a bit things around, but it's very very intuitive. Again, I want to express this in a way which is also for those who are not familiar with mathematical symbols. I mean, it's very intuitive. And so here you have this standard deviation, you have this variability of these movements, right, of the fundamentals. So again, exchange rate, equation number one, which is driven by a deterministic part and a self-fulfilling part, right? Okay, then you have what? You have again, the technicality of how this Brownian motion evolves, how it's characterized. It's a random variable, chi random variable, times the square of the time, infinitesimal time variation. But again, it's technical part. And then what? Then you have the target zone. You have the exchange rate is equal to the target as long as if the exchange rate itself would go beyond the target. So it's not allowed to go beyond the target, right? This is a credible exchange rate, credible target zone. Otherwise, if it's inside the target, below the target, the exchange rate evolves according to some non-linear path, non-linear dynamics, okay? That is going to be determined by the equation. So how do we solve this equation? Basically, what we have is this differential equation here, equation number one, which is subject to these technical aspects of how F evolves, right? And what are the elements implying this evolution. So we start by saying, well, then the exchange rate must be some function of the fundamental variable, right? And then smartly, by assuming this, we say, okay, but if this is the equation, what is the first derivative of this equation? And we come up with the solution, standard solution of a nonlinear, of a first order differential equation, right? So this is a standard type of solution that says what? That the exchange rate follows the usual fundamental variable, the usual path, plus some nonlinear element here, right? That gives you a sort of nonlinear dynamics. Okay, so we have then what? We have that the exchange rate within the target, and maybe we can go to the picture here, just to the intuition of the picture. You see, the exchange rate, whenever there is this top bar here, this target on top, basically, this is a fundamental, right? So the exchange rate would move linearly with the fundamental, right? You see, this is the linear dynamics, alpha ft. But then when there is this line on top, the trajectory within the line resents of this upper bar here. So basically, the exchange rate knows that it will not be allowed to move beyond this, right? So the more it approaches, due to the stochastic process, due to the random evolution, the more it moves towards the target, and the more this expectation brings it down, right? Takes it down. And so you get what? You get, in the end, what Krugman dubbed as the honeymoon. What is this honeymoon? You see, this honeymoon is this difference here. The difference between this H is the honeymoon, right? This difference here. So basically with a linear, without this target here, this target on top, you would have that the exchange rate is hit when the fundamental reaches this level, FTFF. I think you can see my mouse moving, right? But when you have this target, and this target has been credibly established, credibly set, then you can actually move more with your fundamental. Think about monetary policy and the exchange rate, right? In a monetarist, monetarist approach, the more money you print, the more depreciated your currency is, right? Well, but if you know that your currency is not going to depreciate beyond the given level, and this is credibly set, the conclusion here would be that you can actually print more money. You can actually have more leeway. This is the honeymoon. But then what? Then you can actually get the opposite result when this target has been set, but has not been credibly set. So here the expectations work in the opposite direction, the opposite way, because the more you approach this target, and the more people know that this target will be overtaken, right? And so you have the opposite dynamics taking you up there. Okay, so this is the basic structure of the honeymoon divorce target zones model by Krugman and with the evolution. So this is the technical part of the divorce. And you have this probability of, whenever you get closer to the target, how likely it is that you will remain within the target. If that is very likely, then it stabilizes. And how likely it is that you will actually overtake the target. And so if it's more likely that you will overtake the target, then the dynamics follows the opposite direction, okay? Now, what I've done has been to apply this to the case, and here I'm coming to the question that Marta was asking, to applying to the case of the public debt crisis, euro area crisis, and to the globalization. And of course, the key thing here is to identify the cost correctly. Marta, immediately put the finger to the actual point. So what I've done here then is to start with an equation of the interest rate. The interest rate is given by a given, plain vanilla, the interest rate which is set by the central bank, plus a risk premium, okay? This risk premium itself depends on what? Depends on the level of the public debt, for example. Of course, if Italy has 130% public debt, 160 maybe in these days, we are heading towards 160%, given the pandemic, then of course it's more risky than Germany, that has a lower GDP, a public debt GDP ratio. But there is also a self-fulfilling element. Again, if people expect Italy to be not to be solvent, then that increases the risk premium. And so the interest rate equation can become this one, in which the interest rate depends on some fundamental variable, again, the level of the public debt GDP ratio, but also on the expectations itself, on themselves, on the interest rate, okay? So you have the same idea that you have the interest rate that whenever it reaches a given level is not allowed to move beyond that level, and you have an equation which is the dynamics of the public debt. This is a standard equation saying that the public debt to GDP ratio increases when public finance increases, when the primary surplus increases, F, fiscal policy. It is reduced by monetary policy. If you print money, you reduce public debt, right? And then it increases depending on the difference between the interest rate and the GDP growth, okay? This is a public debt to GDP ratio. So if you have economic growth, the ratio decreases, right? So this is, again, very standard, dynamics of the public debt. And to which we add the possibility that the public debt can also move stochastically, right? And so we apply the same little tricks, the same details, technical details that were appearing in the target zones literature. Now, the other crucial thing and the tricky thing is what? Is how we identify the target, right? how do I identify the interest rate target? You know, here, now the graph is the same, but of course here there is no exchange rate anymore, there is the interest rate. So how do I identify this target? With the exchange rate, is you have a fixed exchange rate. You have a number, right? I don't know, 700 liras per Deutschmark. That's clear. But how do I identify this interest rate? Well, the idea is that you identify that interest rate target with a stability condition of public debt. When is it that public debt is stable, is sustainable? It's sustainable when it doesn't grow. Well, but when it stabilizes, right? So we had here this equation here, that the dynamics of the public debt, reflecting the dynamics of the public debt. Well, when this is zero, then we can, in steady state, when there is no stochastic variation, then there we have the target. So the interest rate that assures stability of the public debt is this one. That depends on the GDP growth. Of course, the higher the growth of the economy, and the higher is the interest rate that you can afford, guaranteeing the stability of public debt, right? The higher is the primary surplus, S bar, and the higher the level you can afford in the interest rate, okay? And of course, on the contrary, the higher the public debt to GDP ratio, and the lower the interest rate you can afford to pay on the interest rate ratio. So this defines the target, okay? So I hope I answered here the question that Marta was asking. So this is how the interest rate is defined. And then we have what? We have a linear relationship between the public debt on the horizontal axis and the interest rate on the vertical axis. And so without target, we would have this linear relationship, this straight relationship, this line. But when we know that this is going to be satisfied, to be respected, this target, then we have again this stability condition here. Now, I think the intuition can be, let's see here what we have. Yes, the intuition can be given. When is it that this is stabilized? Well, for example, it is stabilized when considering a more complete model. You see here, for example, in this equation, the interest rate, I have ignored one element. You see this element here, MT dt, is the possibility to monetize debt, right? To print money, to make debt sustainable, right? Now, if we put this back, I've not used it here. If we put this back, let's see where if we put this back, we will find it here together with S star, with the primary surplus. So the interest rate can be made, this target can be met anytime you have monetary monetary financing that you can rely upon. Okay, so whenever, for example, you have a lender of last resort, whenever you have a central bank ready to intervene to satisfy the public debt, then there you are sure that the target will be respected, that the interest rate satisfying the stability condition, the sustainability condition for the public debt is going to be satisfied, right? So that is credible. Think about those of you who know a little bit of the euro area. There was an example that Paul de Grauwe was bringing, and he was saying, how is it possible that the United Kingdom was not subject to a speculative attack during the same time when Spain was subject to a speculative attack, right? Because what is surprising? It's surprising the fact that both the United Kingdom and Spain had the same public debt to GDP level. So how comes that Spain was attacked and the UK was not, if the level of the fundamentals was the same, right? And here, the answer that he gives is that there was the monetary backing by the central bank in the case of the UK. There was the Bank of England ready, since it was, the UK is a standalone country, is a country that can rely on its own central bank. Spain was not. Spain had a central bank that was the European central bank, was not the Bank of Spain, ready to monetize the debt. Okay, so this is what made the UK responding to this case, and this is what made Spain instead responding to the other case, to the case of the divorce, to the case in which you have, like in the case here, you have the unstable trajectory, right? Why? Because you know that the central bank is not there, ready to monetize, and you know therefore that the more you get close to the target, the target of the interest rate, and the more there are chances that you will go beyond this target. Okay, so in my view, and well, it looks like it has been, the idea has been accepted. The same structure of target zones could apply, may well explain the case of the public debt of the crisis on the euro area public debt by setting up this interest rate target. However, it's also possible, you see here, let me show you, just playing around with, no, maybe it's down here. Playing around with equations is also possible to set a different target. So it's also possible to say that the surplus, the primary surplus, here is F, is the opposite, but the primary surplus is also depending on the, can also be identified as a target. So basically, I can play around, and rather than having here a target for the interest rate, I can set up a target for the primary surplus. And this is what I do in a different paper, where I recast the model, but having the primary surplus here. So I hope the basic idea went through. You got the basic idea. So here, for example, I'm showing how, again, in technical terms, considering the case, I have a message. Let me see whether I have. Well, it maybe is not referring to me. So with the different modeling, this is the second paper. It can be shown this role, the role of monetary policy, right? And so it can be seen that the credibility. This credibility depends really on the ability that you have to satisfy that constraint, right? In the exchange rate, for example, the fixed exchange rate case, the idea was that you could be credible if you had sufficient foreign reserves, right? In a fixed exchange rate system, when is it that fixed exchange rate system can be defended? It can be defended when the central bank has a sufficient stock of reserves, of foreign reserves, right? So this was brought in this model and was shown that credibility could be gained thanks to these reserves. And here, the same, this is basically saying that the honeymoon here, this difference, is due to the presence of M of monetary policy, to the fact that the central bank is there ready to play the role of a lender of last resort, therefore assuring the sustainability of public debt. Okay, so I hope this convinced you that the target zones methodology could be applied also to the case of public debt crisis. But then let's move to the other application of target zones methodology. And let's consider then the case of globalization, economic globalization. There have been basically, the last wave of globalization is the one that started at the beginning of the 80s, end of the 70s. Usually we say with the neoliberal revolution of Margaret Thatcher, Ronald Reagan is the thing that moved the world from the second to the third phase of globalization. That phase was already a phase in which some criticism was developed. We all remember the riots in Seattle, the Genova, and so on. However, that wave of criticism was, well, was really went unheard, basically, was coming from leftists parties, was coming from developing world, multinational companies were perceived as, creating, stealing the jobs of unskilled people in less developed countries and maybe exploiting them. This was the narrative of the time, right? That the Western countries, developed countries, were exploiting Southern countries. And this is why globalization was not liked. There were some economists, Stiglitz, Roderick, who were, flanking this idea. I was also, criticizing at the time. I remember some of the meetings we had at the beginning, when the first time in the 2000s, when I started, coming to the ITFA. But basically, those criticisms were really, not so. There was this idea of there is no alternative. What do you want to do? And you remember there were these political positions also. Tony Blair, Schroeder, Bill Clinton. So the idea was that, yes, you can be leftist, rightist, but globalization cannot be discussed, cannot be, something you cannot go against. But then we go to the latest years, the latest decade, when you had Trump with his America First motto, when you had Brexit, let's take control back of our country. And so the issue became more serious. Now the criticisms were coming from right, let's say, and from developed countries. And so multinational companies were perceived as stealing the jobs of unskilled people in developed countries. And so populism and all that we know, okay? So we came to realize that there is no alternative. The paradigm that there is no alternative that Margaret Thatcher introduced was not really the correct one, because in fact, globalization can actually go back, right? Although maybe this is exaggerated, as Irene was telling us in her brilliant, wonderful seminar some time ago. Okay, there are data that are telling us that there is actually a backlash of economic globalization, at least a slowdown. I mean, there are signs that globalization is actually slowing down. So let's go to the formalization of this problem in the case of globalization. So, this was the question that Marta was asking. In fact, she was asking about globalization, with which target. So let's say that you have now an equation in which you have the costs of globalization, depending on the state, on the level of globalization itself, right? I can say 1-to-1. The more globalization proceeds, the more it implies costs, social costs, right? Roderick already at the time was saying that economic integration was bringing social disintegration, right? So there are social costs, and this is why the state has to intervene to compensate the losers and so on. But again, the costs have also a self-fulfilling component, right? There is this post-truth, there are these fake news. So the important is not the facts, it's not the fundamentals. The important thing is what people believe, right? So there is certainly a self-fulfilling element also involved in globalization, right? Because it doesn't matter whether the unemployment rate in the US is 5-6%. If you have a group of people who are saying that globalization is bad, then globalization becomes bad. You have social media, bouncing back this message, and so that's the point. So again, you can have the same thing. Maybe we change a little bit. We introduce a drift. We change a little bit the modeling, saying that globalization proceeds over time. There is a drift of globalization. So we change a little bit the model, but we keep this basic structure. I'm not repeating. And again, we have what? We have a target for the costs of globalization. So the idea is, we know that, or people expect that globalization is not going to imply costs that go beyond the given level, right? So citizens know in a way that the government is taking care of them. And so it's not going to allow globalization to exceed the level that will imply costs beyond the given target, okay? So that's the main idea. So if you want, we can have here the same story. Here is the cost of globalization, which has a linear relationship with the globalization itself, economic globalization. And again, you see, you have that if people believe that their government is not going to let the cost of globalization exceed a given level, they are ready to accept globalization. This is what was happening during the Clinton years, when people were confident that globalization was good. Don't worry, it's not going to harm us. It's not going to create troubles. So the government is going to, not to, to do good, not bad. And this expectation was actually giving a leeway to globalization. Globalization was going even farther than it should have, right? There was, in fact, if you remember, the title of a work, I think Roderick himself, Has Globalization Gone Too Far, right? There was this title of one of his contributions. So this was the honeymoon of globalization, the 90s, when globalization was going unchallenged, was proceeding unchallenged. But then what happens? It happens that at some point, people realize that these costs are becoming heavy. These costs are becoming unbearable. The expectations change. And as you see, the expectations imply what? Imply a divergence of this trajectory. So rather than stabilizing and allowing this honeymoon, the expectation that the costs are going to be the level of the cost is going to be it's going to be on the shoulders of citizens, then the expectations change and this trajectory moves the opposite. And so if it moves the opposite, you see the level of globalization that you can reach is much lower than the one that you'd reach without expectations. So now expectations are playing the opposite role. Now they are actually hastening the divorce, the departure from globalization, right? And so this may reflect, in my view, and this seems to reflect the actual departure from globalization. Finally, the final point, and then we leave time for globalization, for the questions. I've actually changed this model by introducing the hypothesis of heterogeneous agents. So what does it mean, heterogeneous agents? It means that basically agents do not all see the same. And the agents, the higher the proportion of agents who believes that the target of the cost, the target of the globalization is going to exceed the value that the central bank, the government, has committed to resist, to defend, and the higher the probability then that this level has been already overtaken, right? So again, the intuition would be, the reasoning would be rather intuitive. The probability of getting beyond the cost, right, that citizens can stand, this probability depends on the level of globalization. The more globalization proceeds, and the larger the proportion of people will be, proportion of those who think that globalization has already overtaken the boundary, the limit, the target, right? So there is a threshold level, G star, which is included. It's a probabilistic evaluation, right? So there is this span, this interval between G lower bar and G upper bar, and people wonder, where is it? Where is it the target? So the more globalization proceeds, and the larger the proportion of people will be of those who think that it has actually already gone too far, globalization, right? And so the probability of getting too high on the level of globalization is increasing. Now, if it can be shown formally that if this is the case, then the passage from honeymoon to divorce is smooth, and it goes like this, right? It moves like this in a smooth way. So where is the improvement here? The improvement is that it reflects the gradual passage of globalization from the time in which there was a honeymoon, this part here, we were very far away from the upper level. Globalization was low, the level, so people were confident that everything was good. But the more that was increasing, and the more people became anxious, and the more it gets, gets higher the level of globalization, and the more the anxiety increases. You see, and then you have this different dynamic, different path, which is now diverging, which is now, going steeply up, right? Now, these are the two contributions, but then I have a question for you. Any ideas, suggestions for further applications of target zones modeling? So my claim is that this is a very fruitful approach. This can be applied to several different situations, right? So maybe this would be very nice. I would be very pleased if in telling you the stories of the exchange rate target zones, the public debt target zones, the economic globalization target zones, you thought, well, but maybe this is similar to this other problem. So I would be curious to know, and maybe eager to collaborate if you have ideas on this, and we can maybe set up a different modeling to represent something different. Okay, so I would stop here. I hope that I've been clear enough, and I made the points.
Wonderful.
Clearly, and thank you.
Yeah, thank you, Pompeo.
Thank you.
Wonderful presentation. Thank you. So I will open the floor for questions, and so remember to unmute and mute once you have asked your question. So who wants to go first?
Pompeo, can I ask you a question?
Please, Joe.
I'm just going to focus on the globalization part that you did at the end. It's a great paper, actually. But I have the following concern. In other words, if you're talking about cost of globalization to, let's say, the Italians or the Spaniards or the Americans, it's really divided in two components, isn't it? In other words, there's a dislocation cost to people who are negatively affected by having their jobs exported overseas. And then on the other end, there's a consumer gain if, in fact, they're benefiting from lower prices in terms of international trade. And so moving heterogeneously makes sense, but also introduces the idea that some people would petition the government at the lower end of their ability to continue working. In other words, if this dislocation is above some gamma, they're going to basically argue with the government that they got to stop whatever they're doing and bring back those jobs. Whereas 1 minus gamma is going to be a group of people that are benefiting it from both sides. They have industries that are not negatively affected, and they're still getting the positive impact from lower prices. I mean, I think you can do that in the latter end of the model by saying, well, I have two groups, one of which is either going to drop out of the market, and in which case I have to subsidize them. So the instrument for the government has got two components as well. One is to either limit the outmigration of employment, which becomes, a standard micro cost, shadow cost, and or a subsidy to those who are negatively affected by the migration, whereby, the subsidy is a lump sum subsidy, just stay out of my way. I'm not going to worry about you training you. So, I mean, that's what I was thinking about it when you were doing the latter part, is that you've got, in heterogeneity, you've got two competing groups. And you can see that in the US context, where the part of the US population is totally negatively affected by international trade. In the middle, sort of the hollowing out stuff. And those that are just going to win on both sides, both in terms of jobs as well as prices. Anyway, so that's my way of sort of adding, another little glitch to this thing.
Yeah, thank you. No, I fully agree. And I thank you for the suggestion. I mean, I'm going to think about this, how to improve it. I think that the point here is that, maybe you want to ask then, but who is going to prevail of the two groups? There is one group that is the group of the winners and the group of the losers. And the whole point is that when expectations are playing a role, there is no story. Those who are losing have more voice, and then and the story comes as we know, as we have seen, no matter how good the situation may be, the social costs are perceived as being much higher than the benefits, than economic benefits, right? So, precisely the structure of the model that says that the costs depend on the expected variation of the cost, on how the costs are going to affect me. Then when there is this part which has a more to say, which is a larger potential effect on the outcome, then they prevail, and then they are the ones in the group. They are those who prevail, and so their position is the one that prevails, which is the one that is currently prevailing against, or wary of globalization, I think.
Yeah, but I mean the trade-off is the size of the subsidy for those being hollowed out versus the gain to the rest of society. And as long as the gain is greater than the subsidy cost, you're ahead of the game.
Yeah.
But
Yeah.
This is something that was tried back in the 80s in terms of retraining, and it didn't work on trade adjustment assistance. But now, forget the retraining, you just sort of do a lump sum check, which is the Chinese approach in Africa. I pay you, stay home. Don't bother me.
Mm-hmm. Yeah, no, but I think that the crucial point here will be to add some policy variable, which is not there, right? So I think that the good suggestion that you're giving me is to put some policy variable there, some policy control, to see how this is going to change the outcome. Yes, and I think I fully agree with this. Thank you, Joe.
Yes. Can I just ask a question?
Please, Irene.
Oh, great. Thank you. I just want to go back to thank you for your outstanding presentation, which brought out many complex issues. I just want to go back to the issue of central banks and public debt. In the last 9 months, we seem, in a sense, to have imploded what was a traditional concept that would lead to stability, in the sense that central banks have been really the only agents out there that could hugely increase the public debt in emergency circumstances. And so we see them pouring more and more money and more an increase of indebtedness on these very mature and presumably strong economies. But the problem is, where do you see finally that a target has to be set? In other words, how long does this go on? We have very low interest rates. We have all this money pouring out. Fortunately, most of the money pouring out right now is from the Fed and the European Central Bank. In other words, in the world's two largest reserve currencies. So that's fine. But where do you see this eventually going? And how do we set the point where this is really no longer feasible? And then what?
Mm-hmm. Yeah, so in my view, the problem comes when because the central bank, because institutions are not brave enough to accept the idea that that should be monetized, that should disappear. So what you're saying is that central banks are intervening, pouring money, and debt is increasing. But this is only because central banks are not allowed. Think about the European Central Bank. Is not allowed to buy bonds directly on the primary market and say, okay, now I have these bonds and the debt of the single countries is gone. It's not there anymore, right? So that's the problem. So what I'm saying is that with the Graue lender of last resort thing is that if the central bank intervenes by subsidizing public expenditure without implying, allowing public debt to increase, that is the solution. Of course, here we have, in Italian we say un colpo al cerchio, un colpo alla botte. You have, one thing on the other thing. You try to hit both targets with with only one objective. So, in my view, what is missing is to be brave enough to say the European Central Bank is going to print this money, and against this money there is no debt by countries, because this situation is such that we are facing a huge shock. There is no risk of losing credibility, anti-inflationary credibility. We are doing this because there is this huge shock, and the only way to face this shock, in order not to run the problems that you are raising correctly, where is this going to end? What will happen to the public debt of these countries? There is this, you see, there is this thing that the central bank is buying, the ECB, right? Is buying these bonds, but there is a debt and there is the assumption that they will keep buying, rolling over the debt over and over again, right? But they don't have the courage to say, okay, let's stop. This is, let's stop the debt. This is not debt anymore. Let's cancel this debt. This would be.
Can I ask you a question, just
please?
To follow up on Irene in terms of
Yeah.
where is the limit? Thank you for the paper. Okay, I think it's time to have a paper like this and the discussion like this. But let me pose something to you. We know a few things, with relative certainty. We are going to get other shocks, and they're going to be worse, right? So what we are seeing now is these crises are not isolated. So natural disasters are isolated, pandemics tend not to be anymore. And what we are seeing is a fusion of crises. What we've got is the pandemic, its behavior is like a natural disaster, but we also have an economic and financial crisis. And so for the first time, we've seen a fusion of crises. And any prediction in the future is saying that any major crisis will be a fusion, right? It won't be a sectorial crisis or a regional crisis. It's going to be pervasive across sectors. It will impact labor productivity across the board, depending. So this time agriculture didn't get hit. Next time it could, right? So we just don't know what that next crisis will be. We just know it's coming. So given that, it seems the go-to response for any of these large kinds of crises, which are going to happen again, is monetary easing, which we don't see interest rates going up anytime soon, and government spending. It's a combination of both, right? So while you're saying, yes, we write this off, the question is that this is going to happen more often than not now. They're already predicting another pandemic, which is going to be a lot worse than this. So if we keep, all risk modeling went out the window with this pandemic, right? Every kind of our model just disappeared. So central banks are scrambling themselves, You can set targets until there is another disaster that we don't anticipate what the actual fallout is, and just look at the one we're in right now, right? So I think given that,
it's risky, I think.
Makes sense. I mean, the last, all the bank models failed during this crisis right now, because we could never imagine a scenario of this instant shutdown globally. Yeah. So I guess the question is, how do you handle that piece? Because that piece is not going away.
Well, sure. I don't know. I don't know the answer. I mean, it's too a difficult question for me. I of course, I would say one problem at a time. Now we are facing this, and of course we have to respond to this. The next ones that will come, we'll see. I mean, basically what you are saying is that if we do this now, what are we going to do tomorrow? And what are we going to do the day after tomorrow when another larger crisis is coming?
Same thing, I think.
Yeah. It's difficult to say, but certainly what we are experiencing is the fact that monetary expansion is not going to drive inflation under these conditions. So we cannot say, we cannot do it because there is a risk of inflation. Inflation, when the economy is depressed, is not a risk, at least, for the time being. When it will be a problem, I think the Grau is also arguing this. Then, of course, the monetary policy will be reversed, and will take care of the new problem. Now we have this problem. I think it's like in the 20s, when there was the big depression, and there was nothing to be done, and what has to be done has to be done. In that case, in fact, monetary policy didn't.
Maybe the marker could be labor productivity.
Say again?
In all cases, that's what gets affected.
I don't know. I mean, again, I'm not sure about what to answer to this question. I don't know. Yeah. In fact, I'm not sure that I got. What about? Please repeat again the question about productivity. I didn't get the connection. Productivity.
We know that under these circumstances, inflation is not really a concern for the market, right? Because we understand what we're doing.
Okay.
But labor productivity is being impacted.
Okay.
So maybe the marker for
Oh, yeah, yeah.
targets is labor productivity, right?
That might be, yeah, that might be a good suggestion, a good thing. Yeah, yeah. And I'm thinking about, especially about Italy, where we have this problem of labor productivity. Yes, and certainly the crises that we are facing are also going to threaten labor productivity even more. So that's something that we should be thinking about. Yes, let's think about this together.
And then I just want to, I guess now it's two comments. One on Joe's point with the two groups being impacted through trade. That, to me, that all that all screams of a Heckscher lean or a specific factors model where you've got an expectation of a future wage. So I think even in those models, is once you have that expectation of a future wage, you get very naturally this endogenous transfer potentially occurring, depending, like if you have any sort of let's say voting element drag or something, you very naturally get this endogenous payout to people who are going to be harmed, right? In either an HO or an SFM style model. And then I think so Scheherazad's point about the central bank, and you were talking about the debt as well. I keep thinking about the Sargent and Wallace unpleasant monetary arithmetic paper, where the central bank can just keep rolling over debt until it hits that debt limit and then things explode. And I don't really know where that literature went, but I've been thinking about that model quite a bit in terms of all of this extra liquidity and all of this debt buying that governments have been engaged on, right? Because it's that B bar, that upper debt limit that they face that causes the problem. And I wonder to what extent you can have some sort of expectations game, sort of take your model and then just layer in sort of that kind of paper if you want to think about this growing gap